Hi everyone, welcome back to the audit and attestation class. So today we'll be covering new topic which is specific matter that require special audit consideration. Yes, we'll be covering opening balance testing in this session and we'll do some practice question around the same. So let's dive into for more detail.
Today we'll be covering more of 4.4, which is specific matter that requires special audit consideration. So today and tomorrow we'll be covering all these 6 points like testing of opening balances, investment in security, inventory and inventory held by other, accounting estimate, litigation claims assessment, and entity ability to continue as a going concern. So these are the 6 topics which is, you can say, specific matter that require most of the time special audit consideration, right? In addition to like normal general audit procedure for different financial statement line item, these these are the line items which require like special attention or special audit consideration. So we'll be covering these 6 topics in today's and tomorrow session, and next week I hope we'll be in a position to finish off this chapter, which include like material misstatement, including like internal control deficiency that we'll be covering on next Saturday, and written representation. And then Sunday we'll be finished off with the subsequent event and subsequently discovered fact, and we'll do some practice as well. Right. So this is the plan for this week and next week. So hopefully next week we'll be done with this entire chapter. So let me take you to the notes really quick. One second. Few people are in queue. Can you all see my screen?
Yes, sir.
Cool. Okay. So maybe if I take you quickly back in last week, what we have studied, so that again, I know some of you have studied, but some of you might have not, or maybe I can take you through this really quick. So in this chapter, which is like performing further procedures for obtaining evidence, this is like 30 to 40% of your exam. So this is a very important chapter, and you can say heavily tested in exam chapter, right? In this, we have discussed initially sufficient and appropriate audit evidence. We discuss in detail about sufficiency, definition of sufficiency as well as appropriateness of audit evidence. Then we discuss in detail about general procedure to obtain sufficient and appropriate evidence, in which we discuss general audit procedure like inquiry procedure, analytical procedure. Then we discuss about re-performance, recalculation, observation procedure, and all those respective procedure, right? And then after that we discuss on sampling technique in detail. In that we discuss all 4 kind of sampling technique in detail, and how do we select the sample, and which sampling technique we use for test of control, and which sampling technique we use for test of detail, right? After that, we discuss about specific procedure for obtaining sufficient appropriate evidence, include like analytical procedure. In that, we have done like practical example of different type of analytical procedure, majorly like variance analysis, month-on-month analysis, disaggregated analysis, right? And after that, we have discussed in last class about data analytics, right? Audit under the data analytics and the external confirmation procedure. Hope you remember those, right? In external confirmation, we discuss in detail about both type of confirmation, positive confirmation as well as negative confirmation, and the benefit of those respective confirmation, and when we use the positive confirmation and when we use negative confirmation, right? Hope you remember this. Yes, no?
Yes, sir.
Cool. So now we are ready to jump into the specific matter that require special audit consideration. So we'll be discussing more in detail about topic by topic, or you can say financial statement line item by line item, what all audit procedure you need to perform. But these are the area which require like special audit attention. So we'll be covering this in separately, right? So those detailed audit procedure I kept as an annexure in this chapter, and that's also being available in your books as well, right? So first, let's start with the opening balances. Opening balances. What is opening balances and why we need to test the opening balances, and when we need to give special audit consideration to test the opening balances. One, like maybe like I said, like in US, audit is not mandatory for private companies, right? For the listed company, it's mandatory, but for private company, it's not mandatory. Generally, like the small company do the audit when it is being required by their shareholders, when it is required by their bankers, lenders, or creditor, or maybe major customer, or so on and so forth, right? So there might be possibility like previous year there was no audit has been done, and you have been appointed as a first auditor of the organization, right? That's in maybe like initial audit. So in that case of scenario, as like audit, when you are performing the audit, you will be giving audit opinion on the comparative financial statement, right? You'll be giving current year numbers as well as previous year number, and you are signing. So public at a large will be looking at the financial statement is under the impression that both the numbers you have audited. So both the number you are signing up, right? So in that case of scenario, it is being very important for any CPA to have a detailed understanding of the opening balance and detailed testing of the opening balances. Make sense? Yes, no?
Yes, sir.
Second scenario could be possible when like someone else has audited previous year and you have been appointed first time as an auditor of this company. For example, there is XYZ Limited, for which let's say Nimisha and Kush were doing audit till financial year 2020. Right now, Kashish and Ayush has been appointed for the financial year 21 to perform the audit of XYZ Limited. For Kashish and Ayush, this is like a first year engagement, right? You have not done the audit of previous year number. So for that case also, you need to test the opening balances and you need to take the comfort over the opening balances. But regress of the, you can say, nature, timing, and extent of the procedure in the very first audit, and you can say continuing audit where there is a change in auditor is different, right? That we will be discussing in detail. But when you need to test the opening balance more in detail, or you need to give a special audit consideration, are two scenarios, right? First one is when there was no audit in the earlier year, right? Second one is when there is a prior year audit being conducted by some other CPA firm, and you will be conducting the audit of this year first time. Make sense?
Yes, sir.
Right? And why we need to test opening balance? Because the financial statement have comparative number, current year as well as previous year. Have you guys seen financial statement of any company?
Yes, sir.
Right? I have shared with you like some of the company like Microsoft and General Motors, right? So in those, if you have seen the financial statement, there's always current year number and previous year number, right? So if you are signing up their balance sheet, so public at large, who is not an accountant, who is not a CPA, who is not from the financial background, they get an impression that you have signed for both the numbers, right? So that's the reason it's being your responsibility for the public at large who is relying on the signature you are making on the financial statement to ensure the appropriateness of the opening balances as make sense. So what all things comes under the opening balance of the previous year, right? So first one is like amounts, right? Your sales, your purchases, your cost of goods sold, your inventory, your receivable, your payable, or your equity, and so on and so forth, right? First thing is amount. Second thing is disclosures, right? For example, there is a related party, so it's required a separate disclosure. Segment that required a separate disclosure, right? Third thing is event. So if there is any significant event which has happened in previous year, that is also required a separate disclosure in the financial statement, right? Company accounting policy. Have you seen like the financial statement? They always give accounting policy of the company. That's mandatory requirement, mandatory disclosure required as per the financial reporting framework, whether you use US GAAP or IFRS, you mandatory have to disclose the company's accounting policy, right? So the previous year accounting policy also you are required to disclose. And next one is like contingency and commitment. If the company have from the previous year, that is also required to be disclosed, right? What all things comes under the opening balances? Previous year amounts, disclosures, events, accounting policy, contingency, and commitment. Make sense?
Yes, sir.
No.
Yes, sir.
I know. Cool. So now you need to test these opening balances. What all audit procedure as a CPA you would be performing to obtain sufficient and appropriate audit evidence over the opening balances, amounts, and disclosure. First one is about whether the opening balance contain misstatement that materially affect the current period financial statement. So auditor is required to obtain sufficient and appropriate evidence to ensure whether there is any misstatement in the opening balances or not, right? For that, you need to perform all those procedures, which include like inquiry procedure, inspection procedure, observation procedure, re-performance or recalculation procedure for the respective financial statement line item, which is coming in the opening balance, right? Second is determining whether the prior period closing balance have been correctly brought forward to the current period or restated when appropriate. So first thing is testing, ensuring the opening balance are appropriate. Second thing is those opening balances are being coming appropriately from the previous year closing balance, or is there is any change, right? For example, in previous year financial statement, your net profit is, let's say, $1 million. Is the current year opening retained earning include that $1 million or not? Right? That amount has been appropriately carried forward in the opening balance or not, right? For example, in previous year, your account receivable balance was $100 million, which is the previous year closing balance. Is the current year opening balance is $100 million or not? If it is different, then you need to investigate the difference, right? Make sense?
Yes, sir.
Third is opening balance should reflect application of appropriate accounting policy that have been applied consistently in current period. So what is accounting policy? Like, for example, revenue recognition. Whether you are recognizing the revenue for, like, for example, let's say for any products, you have concluded the recognition of revenue on the dispatch of the particular product, and you'll be recognizing the revenue upfront upon the delivery of the product. And then you have a revenue recognition policy for the services, which you will be recognizing over the period of time. Are you following in the previous year same accounting policies in principle which you have applied in current year? Are those accounting policies are being followed consistently period over period or not? That also you need to check. Like, it should not be like previous year revenue will be recognizing everything upfront, but now in current year you have started to recognize something upfront, something over the period of time, right? Same way, like for example, inventory valuation. So previous year you might be using LIFO, and in current year you have started using FIFO, right? That should not be the case. You need to make sure the accounting policies, whatever you have applied, is being followed consistently in current year as well as in the earlier year. Make sense?
Sir, but sir, if they are changing the accounting policy, then they will be doing the restatements in the accounts, no?
Yes, then restatement is required.
Okay.
And then the appropriate disclosure, the impact of change in accounting policy in previous year and current year balance. They also need to disclose separately. Right, very good point, Shanshin. Next is, if prior year modification in audit report was issued. For example, in previous year, previous auditor has issued any qualification in report. Evaluate the impact in assessing the risk of material misstatement in current year. So whatever the qualification the previous auditor has been issued in the previous audit report, in current year, when you are planning for current year audit, you will be considering that qualification in your risk assessment. right? Accordingly, you will be planning additional audit procedure to mitigate those risks in the current year. If modification remain relevant, if the qualification which previous auditor has given is remain relevant and material in the current year, the auditor should also appropriately modify the current year audit. For example, let's say you have operation in US and you have a subsidiary, let's say in Afghanistan, right? In 2021, let's say in 2020, there was like very much instability in the political environment of Afghanistan, and there was like kind of war between like US troops and Taliban, and because of that, you are not you will not be in a position to go and do the physical verification of, let's say, inventory lying in your Afghanistan plant. And previous auditor has given the qualification that they have not gained the comfort over the inventory balances lying in the Afghanistan, right? In current year also, there is no change in the status, like same inventory is still lying over there. You are not able to sold those inventory, but it's still lying over there. But again, situation is same. You cannot go over there and you cannot do the physical verification. You cannot do the valuation of that particular inventory based on the current position and situation of the inventory, right? So that means what was the issue in previous year for which, let's say, previous auditor has given a qualification that exists and remain the same in current year. So in that case of scenario, you will be giving the modification in the current year audit report as well. Make sense?
Maybe the situation has improved now and they now can modify that, so they need not modify. Maybe.
Yes. So first thing, you will be considering the modification in the risk assessment. You'll be planning additional audit procedure. If those audit procedure, you'll be able to obtain appropriate and sufficient evidence to conclude on the existence and valuation of the inventory, then you are not modifying it. But if situation remains same, then probably you need to end up with the same conclusion.
Okay. But my question was that we verify the opening balances before, like that is the first step, right? So we will be looking at this is the scenario, but then we will be performing all these additional procedures after we have checked the opening balances. So at that point of time, maybe we will not be in a position, right, to.
Yeah. So for example, like this inventory balances, you are not able to validate the existence or probably the valuation of the opening balance.
Yes.
Right. In this case of scenario, and throughout the year, there was no transaction as well, but like balance is still lying in your books.
Right.
So how do you conclude?
Yes. Okay. Okay.
Next is if prior year, I think D point we have done. E point, request management to authorize CPA to perform inquiry with predecessor auditor and facilitate review of their working paper to gain the comfort on opening balance. So this, I think, when we have when we are doing second chapter, which is acceptance and continuous of the engagement, right? At that point of time also we have discussed this. We require to perform the inquiry procedure with the predecessor auditor, right? And to test the opening balance, we need to review their working paper to gain the comfort on the opening balance. So based on like which they have concluded in previous year. For that, what you need to do, you need to request the management to give you access to connect with the predecessor auditor for the inquiry procedure, and wherever possible, you can review the working paper to gain the comfort over the opening balance, especially to the balance sheet items. Make sense?
Yes, sir.
If evidence indicate that the opening balance may contain material misstatement that affect the current year financial statement, then auditor should perform additional procedure to evaluate the effect. So when you are testing the opening balance and you come to the conclusion that it may impact or it may have material impact in my current year financial statement as well. Let's say inventory, we have discussed an example. Let's say in terms of payroll. So when we are testing like opening balances for, let's say, provision for long-term employee benefits, and you concluded that certain assumption considered in the previous year was not right. So let's say maybe inflation adjustment, or maybe morality rate, or maybe you can say instead of CTC, company has taken only the basic salary for the calculation of long-term employee benefit, whereas as per the company policy for the long-term employment benefit, they provide long-term employment benefit based on the CTC. Any assumption has been wrongly taken in the previous year, which may have impact in the previous year balance and the cascading impact on the current year balance also. Right? In that case of scenario, you will be performing additional audit procedures. That means you will be, for example, let's take an example. Previous year, you have taken, let's say, basic salary in the calculation of the long-term employment benefit, whereas you were supposed to take the CTC. So in this case of scenario, you'll be performing additional procedure. You'll be requesting management to do the re-performance of the long-term employee benefit for the previous year, right? And if the difference between the recalculation and the originally concluded number is material to the financial statement, then you might be requesting management to ask the predecessor auditor to change the audit opinion and make an adjustment in the previous year. And then you will evaluate the impact in the current year balance sheet as well. Right? Make sense? Yes, no?
Yes.
Any doubt? Next is, if previous year financial statement require a revision, the successor auditor should request the client management to inform predecessor auditor and arrange for a cooperation in resolution of the matter. Like same example which we were discussing. Now, let's say as per the CTC, you have calculated provision for long-term employee benefit is, let's say, comes as $100 million. Whereas as per basic, they have concluded at $60 million. And the difference is $40 million. And let's say that is material to the financial statement. So this you have calculated, and then you will be requesting the management. You'll be requesting the management to go back to the predecessor auditor with this observation and request them to modify their opinion or update their opinion on the revised financials. So you'll be requiring restatement of the previous year financial statement, right? And in that financial statement, you'll be requesting predecessor auditor to cooperate. And if they want to review the work paper you have performed, you should be cooperating with them to review the work paper so that they will also feel comfortable in revising their audit opinion on the previous year. Make sense?
Yes, sir.
If management refuses or current year auditor is not satisfied with the resolution of the matter, auditor can consider to withdraw or disclaim of the opinion as warranted. Make sense? If you are not comfortable, then you can withdraw or you can disclaim the opinion. The auditor should not make reference of the predecessor audit report in his or her audit report. So in current year audit report, you will be not giving any reference of the predecessor audit report. This is your report. You need to conclude whether you want to give a qualification, modification, disclaimer, or withdrawal. That is completely your choice. So now, so far, what we have gained an understanding, what is opening balances, when we need to test the opening balances, and what all comes under the opening balance testing, and what all procedure required to be performed to gain comfort over the opening balances. Now coming to the type of opinion. Qualified opinion or disclaimer of opinion if there is a gas issue. Gas issue means limitation in the scope. That means auditor is unable to obtain sufficient and appropriate audit evidence regarding the opening balance. Qualified or adverse opinion when there is a gap issue. That means there is a material difference you have identified and management is not accepting the difference. Then you will be issuing a qualified opinion. If the impact is persuasive, then you will be issuing an adverse opinion, right? If there is a lack of consistency in application of reporting framework, then auditor should express qualified or adverse opinion. So this is about opening balance testing. Let's do a practical question over here. An auditor discovered that accounting policy applied in relation to financial statement opening balances are inconsistent with accounting policy applied during the period under audit while conducting the audit of a new non-issuer client. In this scenario, the auditor should obtain a sufficient appropriate evidence about whether change in accounting policy have been appropriately accounted for and adequately presented and disclosed accordance with the applicable financial reporting framework. Second is refrain from placing any reliance on information obtained from review of the predecessor auditor's audit documentation of the prior period. Third is request that management inform the predecessor auditor that prior period audit financial statement require a revision. Fourth is express a qualified or adverse opinion. What is the call of the question? What is the call of the question?
To check that the reason for the inconsistencies inconsistency in accounting policies. So like we discussed that we should check for there should be a restatement and impact of change in financial statement. So that is option 1, which is covering those things. That to obtain the sufficient appropriate evidence whether change in the accounting policy have been appropriately accounted. If this option would not be there, then I think fourth option would be the best option.
Why not second and why not third?
So because second is refraining from any reliance. So on the predecessor, this is not on something related to predecessor auditor. It's our report and we have to give our own report. That's why that gets eliminated. And for the third one, that requires the management inform the predecessor auditor that again that it is about the predecessor auditor.
Yeah. So which one is the final answer and why?
First, we will check that the restatement and the proper disclosures have been made for the change of accounting policy. So that's the best option.
How about others? Ayush, Rahul, Pranjali.
Sir, I agree with what was said. I agree with what the previous answer that he gave.
Same, sir, same.
This is not fair.
Sanchit has explained everything.
Sanchit is rocking. Arjun, Nimisha, you are all good? Vineet?
Sir, first option covers all the points. If we are comparing it with second, third, and fourth as well, so it covers all the aspects.
Cool. Okay, so this is what we have in opening balance testing, right? Any doubt here or anything need more clarification, or anyone would like to share your experience of testing opening balances? So far, so good.
Kamal, I had a question, and probably it's because मैंने पीछे revision नहीं किया अभी, but this last pointer that says auditor should not make reference of predecessor audit report in his or her audit report. हमने first या किसी second chapter में probably पढ़ा था कि हम लोग कर सकते हैं. वो कौन सा case था?
Okay, that was for like component auditor or joint.
So sorry, थोड़ी सी और detail दोगे?
Predecessor auditor mean like previous year financial statement audited by the CPA, right? Joint audit or component audit is for current year. That means current year 3 or 4 CPA firms working together to audit an engagement. Especially like if you see in banking industry or insurance industry, you will see there's most of the time is a joint auditor, right? Where like one audit firm do revenue testing, one audit firm do expense testing, one audit firm might be doing assets, one audit firm might be looking at disclosure, one audit firm might be looking at share capital and liabilities. and then all the 5 firms sitting together and finally conclude on a report and issue a joint audit report in which like we give reference to the each firm who has done the respective work.
So we never studied ऐसा कुछ कि हम लोग predecessor auditor की report पे reference देते हैं. हमने कहीं ऐसा नहीं. Okay, maybe
Not
I.
at all.
Okay, sorry about that. Thank you.